Cannon Asset Management has over 3.2 billion rand of assets under management. And Newell, head of business development at the company, joins us in studio to discuss how current global events are impacting the company's investment decisions. Andrew, let me begin by just saying, in light of Jackson Hole, in light of the PMIs that we have seen today, give me a sense, do you think you'll have to change any of your stances so far, given all that global picture?
Godfrey, I suspect the answer I'll give you probably seems like I'm not answering the question. But the approach that Cannon takes is a very long-term one in nature. Okay. And so these near-term iterations are interesting, but they don't guide our investment policy or decision-making. Yeah. And so the short answer is no. We won't change based on those events.
So what you're saying is that what we have seen in the last couple of days, include Jackson Hole, include the global PMIs, in the long term, has not changed your view?
No. Our view of the world is that global economic growth will continue, although it will be sort of spread across the world. I think most people would share the view that the developed world will remain under pressure for some time. The emerging world will pick up the running in terms of contributing to the global story. From our investment perspective, the decision then is how do you get access to that growth and at what price? Because the natural reaction, I think, of many investors is China and India are the cornerstone of the future economy, therefore go and invest there. Our take is slightly different. Most assets there are quite expensive. And despite the fact that we share the view that the economies are robust, the investment opportunity is quite limited. So we actually would move to the developed world to look for investment opportunities, despite the fact that the local economic situation remains under pressure. Yeah,
which is interesting. Before you come in, what's interesting for me is that the picture that we've seen from the global PMI suggests that there will be no growth in Europe. You're likely to see a recession. That's the commentary that I've had in Europe, at least particularly. But in the US, people are still talking about growth. In the other parts of the world, people are still talking about the growth. But you're talking about the global developed markets, and you're seeing growth there.
I'm saying that strategically or structurally is probably a better word. The growth will come from the emerging markets. Okay. How things pan out over the next 6, 12, 18 months is there are a lot of permutations there. Okay,
not developed markets, developing markets.
Developing markets, yeah. Okay. Emerging markets or dynamic economies. Sure, sure. That's where the economic action will be. But the distinction that I'd like to make is your economic barometers or activity often is not related to investment results or vice versa, as the case might be. So to give you an example, perhaps, as much as the developed or first world nations are under economic stress, there are some really interesting investment opportunities. Recently, people have been burnt by the likes of Facebook, which we know is off the best part of 50%. But in a related industry, Intel is something that looks really interesting. So although America is, I suppose, struggling for economic growth structurally, there are some good opportunities. Conversely, you look at China and India, as I mentioned, other parts of Southeast Asia, which are economically quite robust. You need to be very specific about how you get access to those markets. And so the stance that we take at Cannon is rather to buy assets that are domiciled in the developed world. The reason for that is they are priced low because of developed market home bias, but they get exposure to the emerging markets. That's the approach that we like to take. Yeah.
You mentioned the developed world, and of course you mentioned Europe and America for developed, and developing you mentioned China and India. But what about the guys north of us in Africa? Do you look at them as a possible investment opportunity, or are the markets just too mature for you to look at them at the moment?
From our perspective, we are Africa bulls. We like the story, and Sub-Saharan Africa specifically actually has a really good track record over the last 10 years, looking at different angles, whether it's GDP growth relative to Asia or infrastructure spend. From our investment perspective, we don't invest directly into those markets, to answer the question. The reason is a couple of things. Firstly, most of our mandates prohibit it. We're a South African-only equity house in most of the mandates we run. The other is the markets generally are quite immature and they have liquidity constraints. Regulatory oversight is less thorough than it might be here or in other parts of the world. And the way that we would get access to those countries is by buying South African domiciled firms who have taken steps into parts of Africa. The construction industry is one, parts of the IT industry might be another.
So let's talk about the construction of your general equity fund. Interestingly, you are overweight resources, and in this environment, the picture that was just painted at the beginning of the show was that globally, what you're seeing is a general slowdown in global economic growth. But you are going to resources. How far? What are you seeing?
Well, there's a couple of parts to the answer. The first is, a few years ago, we were massively underweight resources, and we've gradually built that up to a position where today we are slightly overweight.
Since when?
And well, that's been building since late last year.
Okay.
So today, if you measure us relative to the all share index, which is probably the most common benchmark, we're about 4 or 5% overweight. I think I stand to be corrected, but I think in the peer group that is quite a big move into resources. What do we see there? There are a couple of things. The one is the emerging world is a big consumer of resources, and that is where economic growth will remain robust, notwithstanding the fact that growth rates will move up and down as any economic growth rate will. The resource exposure that we actually take, though, is quite specific. So if I could give you some examples, of the big names, we have a position in Anglo-American, but we don't have any exposure to BHP Billiton.
Right.
We think both are excellent firms, and there's a case to be made for both. Anglo-American is more attractively priced at the moment, so that's why we choose that avenue. On a slightly smaller scale, we have a position in African Rainbow Minerals, and you might be aware that they own half of Associated Manganese, and the company that owns the other half is Associated Ore. What we see there is also a price argument. Associated Ore's price has appreciated very strongly, whereas African Rainbow Minerals has treaded water and in fact has dipped slightly downwards over the last 18 months. And there's a big pricing anomaly there. Both good businesses, largely explained by the same asset, but that valuation gap is really attractive to us. So we've gone into African Rainbow Minerals.
In terms of your approach to the resource sector, are you looking mostly at prices right now? Do you have any specific themes within the sector? For instance, are you more in favor of iron ore, platinum or gold, or any particular kind of metal out there, or is it just across the board that you are looking at the resource sector? We
are quite specific. So if I can answer your question in reverse order, we don't have direct exposure to the major gold plays. We do have a position in one of the smaller gold miners, which is quite interesting, I think, Pan-African Resources. And the argument there is a combination of the price of the asset, but also the profitability and the grade of the ore that they pull out the ground. We prefer platinum over gold, and although we don't have direct platinum exposure today, we have a meaningful position in Anglo-American, as I said, which obviously is 80% of Anglo-Plat. Yeah. That, I suppose, feeds into the view that the emerging world will enjoy continued economic growth. Not worrying about exactly how quick it is, there will be demand for platinum, and the near-term turmoil or distress in the industry, whether it's economic, social or political, is certainly not a nice one to walk through, but these are good assets with long-term demand.
You mentioned that, of course, we have near-term issues in the industry, and we all know about them. You know, that's quite well known at the moment. But beyond that, I mean, there's also been moves for quite some time now in the resource industry, in which basically there's been talk of windfall profits. There's been talk of, you know, greater revenue share, etc., with workers. Don't you feel that even if there is a massive takeoff in the resources prices, for instance, iron ore prices go back up to highs, break new highs, etc., that not all that good effect will come through to the company itself, just because of some of the regulations or some of the moves we're seeing right now, which a larger share will go to government or to the workers?
Interestingly, I was going to raise the same point, because I was going to say, Andrew, you're talking a lot about price, but I'm not hearing a lot about the actual management of the companies and some of the issues that they're dealing with. I mean, if one looks at Anglo-American in particular, we know the issues that they're having in South America and also the issues they're having here in South Africa.
I think that, I mean, that raises another point, so we'll raise points for each other as we go. But sure. The two things that we want in any investment are price, as you suggested. I've banged that drum a few times already. The other is it's not just about buying a cheap investment. It has to be of decent quality or better, because otherwise you open yourself to the risk that your price that has come down goes down further. Our resources companies have been, and in many cases remain, under pressure for things like windfall taxes, the ongoing pressure for profit participation in various forms, and so certainly that does impact the immediate profitability of the firms. The point though is we're not forecasting that companies must go from price X to price Y and that is our gain. What we are saying is that these are good assets that are priced very attractively relative to their long-term price, and that mean reversion gives us a nice upside, even if some of that does get redirected to government, labour, or whatever the case.
Sorry, Andrew, we've run out of time, unfortunately, but clearly you're not in the camp that says Cynthia Caro is not doing a good job and you're holding on for the long term. Andrew Newell, Head of Business Development at Cannon Asset Management.